All right, let's work with some concepts from this chapter looking at corporation equity transactions. So this chapter is focusing on the paid-in capital portion of stockholders' equity. The first problem we're going to work with has us preparing journal entries to record issuance of stock. So the company is selling stock for various reasons. The first one we're going to look at is a corporation issues 4,000 shares of $5 par value common stock for $35,000 in cash. The company is receiving cash, so we know we need to increase cash. So we're going to increase cash with a debit. They received that cash because they issued stock. They issued common stock, and the amount we are going to record into the common stock account, which has a credit balance, an equity account, record the par value or the stated value of the stock in there. This particular stock has a $5 par value, 4,000 shares, so we are going to record the total par value of the stock issuance into the equity common stock account. That credit increases the common stock account for the total par value of the stock issued. Any excess that is being paid in over and above the par, which is $15,000, will go into another equity account, paid in capital in excess of par value on common stock. So equity in total increased $35,000, the amount of the owner investment, but we split that $35,000 between two different equity accounts. If the corporation were to issue stock, not for cash, but let's say a corporation issued shares of no par common stock to its promoters in exchange for their efforts, estimated to be $40,000. When a corporation is incorporating, they have a lot of legal costs. They have to hire attorneys. They have to pay a lot of application fees, their cost of organization. At that time, at the inception of a corporation, there's not a lot of cash on hand to pay these legal expenses. Thus, a lot of times the corporations will issue stock to pay those expenses. So they are issuing stock in payment of an expense. The total expense that they are paying is $40,000. It will be recorded as an organization expense. They issued stock, so we need to record an increase to their common stock account. The stock did not have a par value, but it does have a stated value of $1 per share. For purposes of accounting, we don't differentiate between a stated value and a par value. Either way, the amount is recorded into the stock account at its par value or stated value. So 2,000 shares at $1 stated value per share, total of 2,000 recorded into the common stock equity account. Here, in excess of $38,000 worth of services were paid into the organization in excess of the stated value of the stock. Again, the excess will go into the paid in capital in excess of stated value equity account. Again, equity in total increased $40,000, the value of what was invested into the corporation by these new owners. They didn't get cash when they became owners in this corporation, or when they didn't pay cash, or the corporation didn't receive cash, it received services instead. In the third scenario, the corporation issued 2,000 shares, no par common stock, to its promoters in exchange for their efforts, estimated to be worth 40 grand. The stock also does not have a stated value. In a situation where stock is issued with no par value, no stated value, then there is no reason to have any equity account keeping track of anything paid into capital in excess of par, right? Or excess of stated value, because there is no par or stated value. So if the stock does not have a par or stated value, we record the entire amount directly into the stock account. So the corporation receives services. They're essentially paying an expense by issuing stock. The total amount of the stock will be increased $40,000. which represents the total increase in the overall equity. Okay. Again, we didn't need paid-in capital in excess because there was no par value, no stated value at all. In the last scenario, the corporation issued 1,000 shares of $50 par value preferred stock for 60 grand in cash. When we go to record a stock issuance, we treat preferred stock and common stock the same. Thus, the amount that we are going to be recording for cash is the total cash of 40,000 received, debit cash, 60,000 received. The amount being recorded into the stock account is the total par value. 1,000 shares at $50 per share par value, total of 50,000 will go into the preferred stock account. The excess being paid into capital over and above the par value of 10 grand goes into the PIK account. Again, in total, equity went up 60,000. It's just accounted for in separate equity accounts. Our next example is going to have us working with treasury stock transactions. So when a corporation goes out and repurchases their stock, so they go out into the markets and buy them back from owners. They're buying back their own stock and holding it in their own treasury. We call it treasury stock. So on October 10th, the stockholders' equity section of Sherman Systems looked like this. They have common stock that has a $10 par value. 72,000 shares are authorized to be issued over the life of the company. Those 72,000 have been issued and they are still outstanding. Okay, all this means is that they are allowed to issue 72,000. They have issued 72,000 shares, and all 72,000 shares are held outside the corporation. They are currently held by owners. Paid-in capital in excess of par value on this stock was $216. Owners paid an additional $216 over the $10 par value for those 72,000 shares. The company's retained earnings at this date, $864,000. This is an accumulation of profits less any dividends paid over the life of the corporation. Preparing journal entries to record these transactions that occurred during the month of October and November. They purchased 5,000 shares of their own common stock at $25 per share on October 11th. So they went and repurchased some of these shares that had been issued and are still held outside the corporation. They have bought them back. The amount that we are going to record into the treasury stock is going to be whatever we pay for it. The company is paying, let me pull down the calculator so it gets out of the way of the journal entry, $25 to purchase each of these shares, 5,000 shares. They are paying $125,000. So the company's cash will go down $125,000. The cash went down because they bought back some of their stock, which means owner's equity, stockholders' equity needs to decrease. We are going to record it into the treasury stock account, which is a contra equity account. We record the stock cost of $125 as a debit into the treasury stock account. The balance in that account will offset the credit balances of the other paid-in capital equity accounts. So by increasing treasury stock, we have decreased overall stockholders' equity. Essentially, we've bought back some of the ownership, right? So the equity goes down for the stockholders. Then, about 3 weeks later, the company sold some of those treasury shares. Some of these shares that they had bought back in October, they are now reselling them for $31 per share. When they resell them, they're going to receive cash. $31 per share, 1,000 shares. They are going to receive cash of $31,000. So the company will debit cash for $31,000, increasing cash. if they have sold some of this treasury stock that they held in treasury, that treasury stock account needs to decrease. We are going to decrease the treasury stock at whatever cost we had recorded that treasury stock into that account. So when we bought it, we paid $25, which means when we sell it, we are going to decrease this account at $25 per share. So we will credit treasury stock to decrease it, 1,000 shares at $25 per share. We received cash from new owners, the people who we sold this stock to, for a stock that had cost us $25,000 when we repurchased it. So we have an excess being paid into capital from our treasury stock, $6,000. Here, equity went down $125 when we bought back some of that ownership. Then our equity went back up again by decreasing the treasury stock for its cost and increasing the paid-in capital. Then it looks like a couple weeks later we sold all the remaining treasury shares for $24 per share. Okay, we had purchased 5,000. We sold 1,000, so we still had 4,000 shares being held in treasury. We are now reselling all of those at $24 per share, which means we resold 4,000 of our treasury shares. So when we resold 4,000 at $24 per share, the company received another $96,000 in cash. So we will debit cash $96,000. We are going to decrease the treasury stock for its cost. It had been purchased and recorded in the treasury stock account at $25 per share. So we will resell it at $25 per share times 4,000 shares, decrease treasury stock 100. So what have we done? We resold stock that had cost us 100. We resold it for 96,000. We sold it for less than what we had bought it. So we kind of had a little bit of a deficit here. General accepted accounting principles tell us to take any deficit from the resale of treasury stock out of its paid-in capital in excess account. So remember, we had recorded $6,000 into that account previously, so it has a $6,000 balance. It can absorb the $4,000 deficit. So we will decrease the paid-in capital account $4,000. If there was not enough of a balance in the paid-in capital account to absorb the full deficit, we would have to then take any unfunded deficit out of retained earnings. Okay? But this particular problem, there was enough in that paid-in capital account to absorb all of the deficit. Let's take a look at the stockholders' equity section after the October 11th treasury stock purchase. Okay, so we're going to assume we had not resold any of this in November. We're only going to look at equity after October 11th. This was the equity before. Let's see the impact of that repurchase. The impact of that repurchase, notice that the common stock account did not change. The paid-in capital in excess of par did not change. Those stayed the same. Repurchasing treasury stock does not affect the common stock paid-in capital in excess stock, because once stock is issued, it's permanently recorded in these accounts. The retained earnings, in total it did not change, but we put a little bit of a note here just to let everybody know that because we are holding $125,000 of stock in treasury, retained earnings, $125,000 of that balance is restricted. In other words, we can't issue it in the form of dividends because we currently have to reserve it for our treasury stock. Here we can see the contra equity account causing a decrease to the overall stockholders' equity. of 125. Okay? And here is that contra equity account balance after we made the purchase of the treasury stock. So in total, stockholders' equity went down due to the repurchase of the stock. Because stockholders' equity had been 1.8 million, we repurchased some of our company's ownership, causing the overall equity to go down. All right, continuing on, let's take a step back and look at a big picture perspective of the overall stockholders' equity section. So we're going to work with Draco Corporation. They're in their very first year of business. So prior to this year, there was nothing recorded in their accounting system. The following transactions affected its equity accounts. They're asking us to prepare the stockholders' equity section of their balance sheet as of December 31st. They're telling us what happened during this year. They issued 4,000 shares of $2 par value common stock for 18. The corporation's articles of incorporation, their charter, authorizes them to issue a total of 20,000 shares over the life of the corporation. They have also issued 1,000 shares of 12% $10 par value preferred stock for 23. They're authorized to issue 3,000 shares of preferred stock over the life of the company. Sometime during the year, they reacquired 200 shares of their common stock, and they have retained earnings, which was impacted by net income of 50 and dividends of 15. Within stockholders' equity, we kind of have two sections. We have a paid-in capital, which is the amount of owner investments, and then we have retained earnings, which is accumulated profits less any dividends paid. When they issued the common stock, when they issued the preferred stock, the amount they would have recorded into those stock accounts was the par value. We always report preferred stock first because it's preferred over common. It's preferred in terms of its order of being listed in the financial report. It is also preferred in the fact that they get dividends first. We're going to talk more about dividends in the next chapter, but for now, just know that preferred shareholders get paid dividends before common shareholders do. So let's start with preferred. If they had issued 1,000 shares at $10 par value, we would have recorded $10,000 into the preferred stock account. So on the balance sheet, we would see preferred stock has a $10 par value. 3,000 shares are authorized to be issued. They have issued 1,000 shares since the company began operating. All 1,000 of those are still outstanding because there was nothing in here about them repurchasing any of their preferred stock. Total amount of the balance in that account would be 10,000. The 10,000 we recorded into it at the time of issuance. They had sold that preferred stock for $23 per share. 23 times the 1,000 shares that they had sold means they would have had 23,000 paid into capital, which exceeds the par value of that issuance. Par value was 10,000. The 23,000 paid in is $13,000 in excess of the par value. When we issued it, we would have recorded it into the paid-in capital and excess account for preferred, 13 grand. Common stock would be listed next. 4,000 shares of $2 par value common stock were issued. 4,000 times $2 par value, we would have increased the common stock account 8,000. So we are going to be reporting common stock that has a $2 par value. 20,000 shares have been issued to be, or authorized to be issued over the life. Since then, we issued 4,000 shares. But of the 4,000 shares that we issued, we had reacquired some of them during the year. So 200 shares are held in treasury. They are no longer outstanding. total balance in the common stock account of $8,000. When that stock was issued, it was issued for $18 per share. 4,000 shares, it was sold for 72 grand. The par value of the stock had been 8 grand. That was the amount we recorded in the stock account, which means the excess of 64,000 of the $72,000 issue amount would have been recorded in the paid-in capital in excess of par on common. So now we have the paid-in capital portion of our stockholders' equity section. Retained earnings. Retained earnings would be following the stock account balances. Retained earnings would have been increased by $50,000 because net income is closed into retained earnings. And then when we pay dividends, the corporation would have used some of those profits accumulated in retained earnings, decreasing their retained earnings when they paid their cash dividends. So retained earnings increased by 50 for net income. It decreased by 15 for dividends. The retained earning balance would be $35,000. Now that retained earning balance is restricted because the company had repurchased some of its common stock. When that happened, we would have recorded an increase to the contra equity account treasury stock. 200 shares were purchased at $30 per share. The cost of the purchase we recorded into the treasury stock account, $6,000. That contra equity account balance is $6,000, which would be reported as a decrease to the overall stockholders' equity of the corporation. Adding up our equity balances, our total stockholders' equity at the end of the year would be $124,000. This last problem is going to have us taking a closer look just at the retained earnings portion of a company's equity. So exercise 13-16, let me make this a little bit bigger, make it easier to see. Hopefully you can see that okay. All right, this Tuscan Incorporated had a retained earning balance of $60,000 as of December 31st of the prior year. During the current year, they reported the following results. They're asking us to determine retained earning balance as of December 31st of this year, the current year. So they ended last year with a $60,000 balance, which means last year's ending becomes this year's beginning. Okay, so they started with $60,000. During the year, net income was reported. We know net income would increase. Cash dividends of $33,000 were declared and paid. Those would decrease retained earnings. They also discovered this year that it made a math error 3 years ago, and they know they need to correct. So in other words, what happened is 3 years ago when they recorded something, the impact was $12,000 net of tax. In other words, 3 years ago the net income was wrong by $12,000. And that $12,000 needs to be re-added to the beginning balance of the retained earnings this year. When a company discovers an error in the past that impacted income recorded in the past, they have to make adjustments to fix it in the general ledger and retained earnings. So what we need to do is adjust our beginning balance by $12,000. We are adding that to our beginning balance to get our adjusted beginning balance of 72 grand. Okay. In addition, we need to show that that beginning balance was increased by 100 for net income, because after revenues and expenses are closed to income summary in a corporation, we then close income summary into retained earnings. So we are going to show that as an increase. The dividends declared and paid will decrease retained earnings, which means our retained earnings of $139,000 is where we ended this year. Now they do have another item down here, is they revised an estimate of the machine's salvage value this year, which caused a depreciation to increase by $1,000. Okay. The reason they put this here is to differentiate between changing an estimate that had been used in this year and prior years against errors. Okay. Errors in the past require restating financial statement amounts, restating the amounts in retained earnings. But if we were just revising an estimate, we're just saying, based on new knowledge, we are going to revise the salvage value we've estimated for a machine that we've been depreciating. It doesn't mean that based off of prior assumptions, prior depreciation was wrong. It just means we're kind of adjusting things to make sure everything moving forward is correct, right? Because maybe some things have changed, but at the time in the past when we made the assumption, it was a correct assumption. But just because of economic or other changes, we have to revise that estimate. Okay, so revising the estimate does not require any type of prior period adjustment. So it will not need any kind of adjustment in retained earnings. All right, I hope this helps with the concepts in this chapter.